एंड दिस वेलकम टू SOIC। तो आज के इस पॉडकास्ट में व्हाट विल बी डूइंग इज दैट कि अभी अर्ली स्टेजेस ऑफ बुल मार्केट में हो सकता है हूँ अभी, मतलब क्योंकि ऐसा लग रहा है कि मार्केट की ब्रेथ वाइडन होते जा रही है एंड अ लॉट मोर स्टॉक्स हैव स्टार्टेड पार्टिसिपेटिंग इन द ट्रेंड एंड लॉट ऑफ थीम्स आर पार्टिसिपेटिंग इन द ट्रेंड। सो पर्पस ऑफ SOIC चैनल इज टू गिव यू फ्रेमवर्क्स कैसे, जैसे अभी एक यूनिक फ्रेमवर्क दिया, उससे पहले एक TVGP फ्रेमवर्क दिया, फिर स्टेज एनालिसिस आपको एक फ्रेमवर्क सिखाया, देन आपको हमने अर्निंग्स ग्रोथ का एक फ्रेमवर्क सिखाया, ऑपरेटिंग लेवरेज का फ्रेमवर्क सिखाया। तो ओवर द इयर्स वी हैव टॉट यू मल्टीपल फ्रेमवर्क्स। So today in this podcast, we have Mr. Prabhakar Kudva with us, who is the CIO of Samvitti Capital. So it's a SEBI registered Cat 3 AIF. एंड प्रभाकर कुडवा जी अपनी एक ब्लॉग लिखते हैं जहाँ पे वो बहुत इंटरेस्टिंग लर्निंग्स डालते हैं अबाउट द मार्केट एनवायरनमेंट। तो आज हम क्या करेंगे इस पॉडकास्ट में कि हम एक और फ्रेमवर्क सीखने वाले हैं। ये कौन सा फ्रेमवर्क है कि थीमेटिक इन्वेस्टिंग और एक बुल मार्केट को कैसे राइड कर सकते हैं एंड कब थीम्स पीक आउट होने लग जाती हैं। तो हाउ डू वी स्पॉट कि अभी थीम का बेसिकली पीकिंग आउट फेज स्टार्ट हो चुका है एंड जनरली हाउ लॉन्ग थीम लास्ट फॉर। एंड दिस इंटायर प्रेजेंटेशन विल बी डन बाय हिम एंड आई विल डू अ क्वेश्चन एंड आंसर राउंड विद हिम, जहाँ पे हम ये सीखेंगे कि एक फ्रेमवर्क हमारे पास कैसे हम यूज कर सकते हैं टू डू थीमेटिक इन्वेस्टिंग वेल, टू हैव एन एग्जिट फ्रेमवर्क वेल, ऑल्सो टू आइडेंटिफाई कि एंट्री पॉइंटर्स इन डिफरेंट थीम्स कैसे बनते हैं। विद दिस लेट्स स्टार्ट द पॉडकास्ट, बिकॉज इस पॉडकास्ट में मेरी बहुत सारी की लर्निंग्स थी। आपकी जो भी 5 की लर्निंग्स होगी, डू लेट मी नो इन द कमेंट सेक्शन बिलो। So, hi investors. Welcome to a session in which we'll be hosting Mr. Prabhakar Kudva. So, Prabhakar sir साथ हमने कुछ टाइम पहले भी एक सेशन करा था and we discussed about the entire market environment कि overall how the market is, what are the headwinds and tailwinds which were taking place. This session was done almost 9 to 10 months back when we were in a bear market, and now finally we see we are like the market is turning at the moment since the start of the new financial year. So we thought कि why not do this another session on market environment, because प्रभाकर सर से मेरे को overall market environment and market temperature की insight over the years काफ़ी अच्छी मिली। With this, let's start, and thank you for agreeing to do this, sir.
Always a pleasure to talk to you. So yeah, I think we spoke about 8 9 months ago, and hopefully we are in better times now. I think we saw some really dark times. Especially, I think March was quite bad, and I think, but post that the recovery also has been extremely swift. Right. So, what we'll do today, Ishmohit, is we'll try to talk about three main things, right? So, one, we'll talk about the importance of market environment, right? And also how do you gauge the market temperature, so we'll talk about, a small framework. And we'll talk about how you can identify themes, right? What is the importance of themes? Why do themes, happen in the market? How do you ride them? And hopefully, how do you exit them, before, getting into trouble? And finally, we'll briefly cover, optimal portfolio construction. So I'll share my thoughts about portfolio construction and how I go about it. And hopefully it will resonate, right? So a quick disclaimer. So, of course, I mean, all of you, I'm sure your audience is very mature. They understand all this, but I think we'll discuss a lot of stocks and sectors, themes. We may take some names, but as always, these are just illustrations. I personally, my family, my company, we all may have stakes, and we may or buy or sell at any point in time, right, without being able to inform you. So one has to take this purely as an educational content and not really as any investment advice. As per the regulations, I've also put in a link to the regulatory registrations of my firm at the bottom. So those of you who are interested can go through those regulatory registrations. So we are registered with SEBI and we manage a AIF and a PMS. So let's get started. This is broadly the agenda. So we'll cover 6 or 7 main things. The main things are the three things that I spoke about: the market environment, the theme, as well as portfolio construction. I've just broken this down into sub parts. So we'll talk about the market environment, why it matters, and like I said, how do you identify what environment we are in. And then we'll talk about how leadership and themes drive a bull market. Then we'll talk about how to participate in the themes, how to try to estimate, where we are in the thematic cycle. And finally, we'll talk about portfolio construction. I know Ishmohit asked me to, talk about or give you a few resources, that will help you become a better investor. So instead of talking about books, I thought I should probably talk about certain, market elements or certain things that we can do in the market, right? Ourselves, right, which can really level up our game. So we'll cover that towards the end. Let's get started. Okay, so let's start with why should we talk about market environment, right? So why does the market environment matter? If you go back and study your own returns, right, you will see that uh, most of the money that you would have made would have coincided with a bullish phase or a bull market, and most of the losses that you would have seen would have happened in a bear market. It's a very simplistic statement, but it's a statement that because it is simplistic, a lot of us ignore it, but it is a statement that matters a lot. The reason being, there's a lot of data which you can go and look for. There's a lot of research which says that almost 50 to 60% of the returns that we make are purely a function of market environment. So what that means is, even if you don't know anything about stock picking, if you just focus on understanding and predicting the market environment and you get that right, you can get almost 60% of what a very astute stock picker can make, right? So the split that these research papers generally talk about is 50 to 60% is market environment, about 20-30% is the sector or the theme, and the last 10 to 20% is the individual stock picking, right? So we'll not talk about individual stock picking today, but we'll talk about the other 80% that really drives the returns, but is not really discussed much, and not a lot of thought is given to it, right? That is number one. The market environment is very important to our returns. In a good market environment, we have to, tweak our strategy to be able to take advantage of that market environment. And in a bad environment, also, we have to tweak our strategy to ensure that we survive that environment, right? Most people, the mistake that they make is they run the same thing irrespective of the environment, right? So it is like, if there is a farmer, right? So he will do different things in different seasons, right? So there is a time for harvesting, there is a time for sowing, there's a time for waiting, right? But investors don't do that, right? They do the exact same thing throughout, and somehow hope that they will do well. But I feel, if you start considering market environment in your analysis and you incrementally tweak the way you are operating in the market depending on the environment, then you will make a lot more money, right? Today you are leaving a lot of money on the table if you're not utilizing the idea of market environment and incorporating it in your strategy, right? So market environment is the core, right? It is the foundation. Uh, like I said, environment alone is an edge, right? To think about a lot of marquee investors, right? And if you really astutely observe them, right, all of them give a lot of importance to market environment, right? So the if you look at even whether it is a trader or an investor, I know so many of good investors, right, who will operate only in certain market environments, right? Or there are certain traders who will only operate in bull markets. They will, be very aggressive. They will take leverage, and once the bull market gets over, right? Of course, they will take a hit when the first turn happens. But once they have realized that the bull market is over, they will completely exit the market and wait for things to settle down or the next bull market to start. Similarly, if you observe investors, right, a lot of investors, right from Warren Buffett, right? The famous statement, be fearful when others are greedy and be greedy when others are fearful. What is the statement talking about? It's talking about the market environment, right? And Buffett never did the same thing across market environments, right? He measured his aggressiveness and conservatism depending upon the market environment. So the point that I want to drive home is that this is a very, very important component of your return. And if you can optimize this, then your overall returns can really go to the next orbit. So how do we gauge the market environment, right? In my experience, I know I have, these four parameters that I look at, right? Whenever I have to judge what the market environment is like. So the first parameter is cycle positioning, right? So what that means is, where are we in the cycle, right? You can easily do this, to understand this, right? All that you have to do is look at any index, right? Let's say for the broader market in India right now, I think the best index is the microcap 250 index, right? Although it's called microcap, as we've discussed earlier, it is not really microcap in the sense of the word, right? So microcap or small cap or microcap, right? They give you a good sense of the broader market. So if you're focused on the broader market, then you just open up the monthly chart on TradingView and look at whether we are in a consolidation phase or are we in a trending phase. And if we are in a trending phase, then when did the trend start, right? So that gives you a sense of where we are in the market cycle. So if the trend has started very recently, then you know that you're early in the cycle. But if the trend has been playing out or the index has been going up for, let's say, more than 12 months, 18 months, 24 months, then you know that you are late cycle, right? So to take an example of where we are right now, we are definitely early in the cycle. I would say we have not even started the next cycle, because most of the indices are still below their all-time highs, right? So a new cycle will technically start when we cross the previous all-time high, right? So in that sense, we are just mean reverting now from the bear market that we saw, and we are now working our way closer to the high and closer to a beginning of a new cycle, right? So some people take it from the previous, all-time high. Some people take it from the bottom, right? From where the previous bottom happened. But either way, this is this is more of a range that you have to worry about. These are not technicalities or absolutes, right? You have to look at the range. So the cycle positioning is something, the first parameter you have to look at, where we are in the cycle. How long ago did this bullish phase start? Second is obviously the breadth, right? So there are different ways people look at breadth. So a lot of people look at what percentage of the stocks are above, let's say, a 20 EMA or a 50 EMA or 100 EMA or a 200 EMA. Some people look at the percentage of stocks hitting 52-week highs and 52-week lows. There are many ways to do that, but it's important to understand the concept, right? So the concept is, let's say, for most investors, I think, let's say 100 EMA or a 200 EMA is apt. A 20 EMA is more apt for a trader or somebody who's doing some sort of a swing trading or something like that. But for an investor, it will be the 100 and 200 EMA. And if the 100 and 200, the percentage of stocks, which is above 200 EMA, if it is less than 40%, right? Generally, there is you can say that the breadth is not so great, right? And if it is above 40 to 50%, right, and sustaining there, you can say that the breadth is good, right? So similarly for 52-week highs and 52-week lows, right? So a lot of these softwares, provide you this data ready-made. So I think the SOIC's in-house software, stock scans, also provides this. Now, Ishmohit has not paid me to say this, but I use the software, and so the good thing about stock scan or screener or any of these software, what I like is because they're built by investors, right? So they know our pain points, right? So they know what is it that we are looking for, and they have built that. So both screener as well as stock scans, both are doing an amazing job. But anyway, so breadth is something you can check on many websites, which readily provide this information today. And like I said, right, focus on the 100 and 200 EMAs, and if the numbers are above 40, then you can say that we are in a fairly bullish environment. If it is below 40, then you can say that we are in a bearish environment. If that number goes below 20 and tends towards 10, then typically that is when the turnarounds happen, right? So if the breadth is becoming extremely negative, breadth is a buy signal. It's an indicator that things have gotten so worse that it's very likely that a mean reversion rally will happen. It doesn't always mean that a turnaround will happen, but it definitely means that the selling has gone to an extreme, and a rally can happen. But the same doesn't happen on the other side, right? Only negative breadth has signaling power, right? If the breadth is 80, 90 plus, right, it is not always bearish, right? You cannot always say that it will turn around, because a lot of times breadth can remain between 60 and 90 for a long period of time. So if you analyze any bull market, you will see that the breadth will typically be between this, between this 50 to 80 range for a lot of time, right? So that is the second parameter. Third is the leadership, right? You cannot have a bull market without a leadership. You cannot have a an extended period of good performance in the market without leadership. So if you go back and study any period, right, from the 90s up until now, right, every stretch of 2-3 years where we have seen a bull market, right, they were always led by a particular theme or a particular sector, right? And we'll talk about this a little bit more later. But leadership is very, very important, because leadership is what will allow the market to go up. This is what will bring the capital into the market. This is what will make the capital flow into the broader market, right? And the very good example of this right now is Korea, right? Korea is all around us. Everybody's been talking about it for last 1.5 years now. Why did the Korean market, which was down in the dumps, suddenly start performing, right? Because they found a theme that would provide leadership to the market, right? Which was the memory stocks. The third is leadership. And fourth is obviously a sense of liquidity, right? What is happening to the liquidity? The key players, at least in the Indian markets, are the FIIs and the DIIs. And then there are the other marginal players, which is the retail investors and everybody else. A lot of retail investment is taken care of by DII. So I'm talking about the other non-mutual fund investors, right, who are doing things on their own, right? So they are the incremental liquidity, but primarily it is the FII and the DII. So using these four parameters, right, if we have to talk about where we are in the cycle right now, so let's say the cycle positioning, right? So I would say we are still young bull market, right? Because it's been just 3-4 months old, right? So I would give it that 1 point. In terms of breadth, I think if you go and check these numbers, these are anywhere between 50 to 60 right now. So I would give a checkpoint to this. If you talk about leadership, there are a lot of themes which are doing extremely well. Where the growth is extremely high. There are multiple themes leading this market, which is a very, very good and healthy sign for a bull market, right? If there is only one theme, then the bull market, the duration can be relatively short. But if there are multiple themes, then a continuous handover keeps happening from one theme to the other, and that allows the market environment to remain robust. So I would say leadership is also there, and liquidity, right? So the DII liquidity, obviously has been very robust. The FII liquidity has been very bad, but I think that is hopefully changing right now, right? Or if you see the last few days or last 1 weeks, at least the selling has slowed down. So the liquidity is incrementally improving, right? So I would say the current market is a 3.5 out of 4 on this framework. Now, just for a quick understanding, right? If we go back to 3-4 months back, or let's say January, February, March, right? And if you see the cycle positioning, right? So the cycle positioning was, we were still in a consolidation phase from the older bull market, right? So there was no signs of any new cycle, right? So cycle positioning, we were, the new cycle had not even started. The breadth was extremely bad, right? There was no real leadership to speak of to the market. And obviously the liquidity with the constant FII selling was very bad, right? So maybe the number that you would get if you had done this analysis probably in January or February would be maybe anywhere between 1 to 2, depending upon whether if you give 0.5 to liquidity because the DIA was there, FIA was not there. Maybe some leadership was there, a few, maybe one or two themes were doing well, right? But I would say, so this is how you can differentiate between the market environment at any given point in time. You can look at these four parameters. So I hope this gives you a good sense of how to study the market temperature, right?
Now, just before going forward, idea of doing these podcasts is to make you a well-informed and a learned investor. सो एज अ पार्ट ऑफ SOIC मेंबरशिप व्हाट वी डू कि SOIC मेंबरशिप में हम आपको इन्वेस्टिंग सिखाते हैं फ्रॉम स्क्रैच। तो लेवल 1 ऑफ SOIC मेंबरशिप है व्हाट वी टीच यू इज ऑल अबाउट फाइनेंशियल लिटरेसी कि स्टॉक मार्केट में अगर कोई नो नथिंग इन्वेस्टर है तो उसके लिए निफ्टी रैंकिंग फ्रेमवर्क क्या है, उसके लिए फाइनेंशियल प्लानिंग वो कैसे कर सकता है, व्हाट आर डिफरेंट टाइप ऑफ एसेट क्लासेस अवेलेबल एंड म्यूचुअल फंड्स इंडिपेंडेंटली आप कैसे पिक कर सकते हैं। सेकेंड लेवल के अंदर वी टीच यू कि व्हाट इज फंडामेंटल एनालिसिस एंड सारी की सारी जो रेशियोज है ऑफ अकाउंटिंग है, इनकम स्टेटमेंट हो गया, बैलेंस शीट हो गई, क्वार्टरली रिजल्ट्स का एनालिसिस हो गया। सो दीज आर द इंपॉर्टेंट थिंग्स दैट वी टीच इन द सेकंड लेवल ऑफ SOIC मेंबरशिप। लेवल 3 में वी टीच यू ऑल अबाउट वैल्यूएशन कि हाउ टू फाइंड इंट्रिंसिक वैल्यूएशन ऑफ अ कंपनी। एंड लेवल 3 के साथ साथ एक बोनस लेवल अभी ऐड हुआ है विच इज वन ऑफ द ग्रोथ कैटलिस्ट लेवल कि ग्रोइंग कंपनीज कैसे फाइंड करें। तो दिस इज अ बोनस लेवल विच इज एडेड आफ्टर वैल्यूएशन। लेवल 5 इज ऑल अबाउट व्हेन टू सेल एंड व्हेन टू बाय। तो एक पूरा फ्रेमवर्क है ऑफ टेक्निकल्स एंड ऑल्सो द टाइप ऑफ trends that a long-term investor should look at. And finally, level 6 में we teach you the language of different sectors. इसके साथ साथ 3 एडेड बोनसेस हैं. फर्स्ट एडेड बोनस है कि SOIC मेंबरशिप के अंदर आपको स्टॉक स्कैन्स की मेंबरशिप मिलती है फॉर अ लिमिटेड पीरियड ऑफ टाइम. सेकंड थिंग द एडेड बोनस इज कि SOIC का जो AI इन्वेस्टिंग मास्टर क्लास है कि AI को यूज करके रिसर्च कैसे कर सकते हैं, दैट इज अ पार्ट ऑफ द SOIC मेंबरशिप. एंड फाइनली द थर्ड एडेड बोनस is that ki we do market signals, that is every bi-weekly में we cover top down what is happening in the index and the different sectors. So that is also a part of the SOIC membership. So you can register for the SOIC membership because SOIC has just completed 6th anniversary. So there's a limited time coupon that is available by the name of Thank You 6. And the link to register for the SOIC membership is in the description box below. And one more very important thing, that is on 16th of August, we are doing an offline event in Pune where we will be covering the entire factor and the sector of new age manufacturing companies. New age manufacturing industry को आप कैसे पढ़ सकते हैं, कैसे research कर सकते हैं. It's an offline event happening in Pune. If anyone wants to register for that, the link for that is also in the description box below. With this, let's go back to the video.
Next, let's move to the themes, right? So once you establish the market temperature, right? Now, if you do an analysis, right? If you go back, like I said, right, study any bull market, right? It will generally be led by themes. The biggest money will be made in the leading themes that are driving the bull market. So it is apparent, right? It is apparent that you have to look for these themes and you have to participate in these themes. Now, to the extent that you participate is up to you, it's up to your risk profile. But the fact of the matter is, if you are not participating in the leading themes of a bull market, then you are, I mean, what are you really doing, right? So, it's imperative that you understand, how these themes work, what do they look like, to identify them and then, allocate to them to be able to participate. So what are the few characteristics of, leading themes? Let's look at that, right? So obviously, the first characteristic is very high revenue growth, right? I've deliberately not put profit growth here because generally yeah, all the themes, right, will show super high revenue growth. Underlying stocks of those themes will show super high revenue growth, which typically will be north of 30-35%, at the top line level. So any theme, you go back and check in the history will be characterized by the underlying stocks showing you very high revenue growth. So if you are looking at a set of stocks which belong to a particular sector or a particular theme, right? Then and all of them are showing you a very high revenue growth north of 30%, right? Then you can say that yes, this can possibly be a theme, right? This can be a robust theme, right? So the second thing is you need to have an open-ended story, right? You need a TAM, right? The total addressable market that isn't fully quantifiable, right? So right now, AI is a theme because, all the AI ancillaries are growing very fast and it's an open-ended story in the sense that we don't know what is the, final TAM, right? How many people will end up using AIs and whether it will be only people or even, robots will consume and, so many different things, right? So it's a completely, open-ended story. Similarly, if you look at same thing, if you look at the internet, the dot-com boom, it was all about an open-ended story, right? So any powerful theme will always have an open-ended story because the open-ended story is what allows the market to extrapolate the current super high growth many years into the future, and that is what allows the P re-rating to happen, right? So if the open-ended story is not there, then there is no rationale for the market to re-rate the PE ratio, right? And there will be no justification for re-rating the PE, and a theme will not happen. So you can have individual stocks that do well outside of the theme purely because they have a good revenue growth, right? But you, for a real theme, you need an open-ended story, right? The third one is obviously they have to be new stocks, right? So generally in any theme you will see will be stocks which people would not have heard of in the last 4 or 5 years, or they would not even be talking about it. So if you look at the stocks which are driving these themes, right? If I can take some names, let's say TD Power, Power India, or if you look at MTAR or any of these AI names that are very popular nowadays, right? These are not names which anybody had heard of 3 years back, right? Nobody was really talking about it, right? So when I say anybody, I mean, there would be individuals, or research guys who would have done the work 3 years back, but they're an exception. But broadly speaking, they will be new names, new set of stocks. So that is the third criteria. And fourth is you need the stocks to be institutional quality, right? So if you're getting a theme in, a particular sector where only some micro cap or small cap is there, then that theme cannot lead the market. You need institutional quality stocks, which means that you need stocks with, where there is a perception of good corporate governance, where there is a perception that the management is good, where there is a liquidity and a fair enough, a large market cap, right? So it should ideally be in the stock should be in the mid cap or large mid cap type of, that is the sweet spot for institutions, because you need institutions to drive the stocks up, and you need institutions for the PE re-rating to happen. PE re-rating cannot happen by retail investors, right? Any long trend that you see in the market is driven by institutional money. So if the underlying stocks are not institutional quality, then you're not going to have a big theme. So these four, I feel, are the most important parameters. And then there are certain, I would say, smaller parameters, right? So the other thing is, if you have to be sure that a theme, something is a theme, then you will start seeing, after the first leg, which will be dependent on these first four factors, where the leading stocks will do well. Then during the middle phase of the theme, you will start seeing the marginal names also break out, because the capital will want to chase, these high growth stocks, right? Capital always chases high growth stocks. We'll talk about that a little later, but you will start seeing random names, which will start participating, which is happening now in the AI ancillary or the power, related trades, right? Whereby, names in which, randomly, if they talk, if the word data center is there in the con call, the stock can get re-rated. So you will start seeing that kind of a behavior, right? So when you start seeing that kind of a behavior, that doesn't mean that the story is over, but that means that the story is probably in the second half, right? So that is what you have to infer from that. And finally, number six is, another tell is the correlated movement, right? So if any good news or bad news comes, this entire group of stocks will move together. They'll go up or they'll go down together. That is another smaller factor you can look at. And finally, relative strength, right? Relative strength is useful to identify the themes, because, at the beginning also, because what happens is generally a new cycle starts after a bearish phase, right? And when this bearish phase is going on, and, when this bear phase turns into a bull phase, the initial set of stocks, right, which break into 52-week highs, or which were showing relative strength when the overall market was falling, they are the stocks that actually end up becoming the leaders of the next bull market. And this is typically seen, right? So whenever there is a turn in the market, right, a big money is made, right? And big money is made in two types of stocks. One will be these type of stocks, which were showing relative strength in the bear market, where there was not much selling happening because they were new names and because they will have a high growth rate. So as soon as the bear market ends and the capital starts flowing, these will be the names that will do extremely well. So that is category one. Category two, which does well on market terms, is stocks which are extremely beaten down. Because in a bear market, what will happen is the market, Mr. Market, right, which Graham talks about in his book, right? He will be depressive, right? So he will take the stocks, certain amount of stocks, it will price it for ruin, or it will price it for bankruptcy, so to speak, right? So when the markets realize that no, that's not happening, right? Things are getting better, you will see the beaten down stocks do very well, and you'll also see the relative strength stocks do very well. So different type of people, depending upon their personality, will be able to, buy, one of these two categories or a mix of these two categories. But for us, from a leading theme point of view, you will always see that the leading theme stocks will always demonstrate throughout the length of their run. They will demonstrate relative strength, which will be in the top 90 percentile of the overall market. So this is what you have to look for to identify the leading theme. Focus on the first four. Whenever you see the first four, in any story that you come across, I think, and you see that happening for multiple stocks in the same sector, then you can be sure that that is the theme that is leading the market. So a few quick examples, right? Where if you, applied this framework, then you could have identified the themes, right? So let's say 2021 to 2024. So there were three themes, there were probably more, but I've put in three here. So defense, hospitals, and PSU banks. Defense, right? If you look at defense and you go back, right? So a lot of companies which did well in the last cycle in defense, right? The shipyards, all of them were showing very high revenue growth. You can go back and check, right? Number two, completely open-ended story, right? Because defense, the indigenization, the export, and it's a huge market, right? It's a huge market. So completely open-ended story that allows for a PE re-rating. New set of stocks. How many of us had heard of Masdaq or a GRSC or Cochin? They were all new stocks at that point in time, right? And institutional quality, because the market caps were big. There were no known issues. Corporate governance was decent. Of course, there were PSUs, but they were stocks which institutions could buy, right? And we also saw the marginal names break out, right? We saw so many other smaller defense players do well, towards the second half of the run. And finally, relative strength, right? Throughout that phase, all the defense stocks, up until 2024, September, October, right? Defense stocks were all showing immense relative strength. So defense is an example of what a very good quality theme looks like, right? And there is a reason why I have put these three examples here, right? Because in the order of importance, right? All of them were themes, but the strength of the theme was different. So defense was it's a very powerful theme. Let's say hospitals did very well, right? A lot of these hospital companies were showing very high revenue growth because I think the capex had happened and they were kind of milking that. Open-ended story, right? Hospitals, that huge addressable market. So you could explain that this is like a quasi-consumer kind of a story, right? So that was the narrative. New set of stocks, stocks we had not heard of, Narayan Vidyalaya, and so many of them which did well, right? New set of stock, and of course, institutional quality, because they were not like small micro caps, they were mid caps, right? Mid caps to large mid caps, right? So again, it is still, it's not as great a theme as defense, but it was a good theme. Finally, PSU banks, right? So PSU banks, super high growth, no, because the revenue growth was not really there, right? It was more to do with the improvement in the balance sheets and the write back of the provisions, which were leading to extremely high profit growth, right? So in the first pointer, I would not give. Open-ended story, not so much, right? There's nothing as such in the banking sector, right? It's a hyper competitive sector. A new set of stocks, kind of, yes, because what happened was, a lot of these stocks which did well, right? They had not done anything for the last 5 to 8 years, right? So in that sense, they were new because nobody was talking about them. Institutional quality, a lot of institutions already owned them to some extent. So fairly institutional quality. Marginal names breaking out. This absolutely happened because a lot of these low float names, I remember, I don't have the names right now, but maybe IOB and some of these names which were having let's say 90% owned by the government of India and 10% float, they did exceedingly well for in a particular phase of the market, right? And relative strength was obviously there. So maybe out of seven, you would get maybe 2 or 3 points for PSU banks. So why I'm talking about these three examples is because every theme need not be equally powerful. So you have to be able to judge, right, which theme is checking all the boxes and which theme is which is so right. It's good, but it's not something out of the world, right? So that is why I picked these three examples. What's happening right now is so the themes which have been playing out for the last many months, right? So obviously power, AI ancillaries, CDMO, and there may be others, right? Energy transitions, I have not named them, but you can go back and run it on this kind of a framework, right? Whether the companies are showing super high growth, open-ended story, new set of stocks. See, this analysis has to happen at the beginning, right? This analysis cannot happen now, right? Because now everybody knows about it. But this framework is important at the beginning of the cycle, or or whenever you're finding a new set of names doing well. That is when you have to do this analysis to see whether this can become a powerful theme or not, right? Now, these have already become a powerful theme, and like I said, right, we don't know where exactly we are. Maybe we are in the middle, maybe we are slightly ahead of the middle. That is something that is debatable. But the point is that the next time you identify a group of stocks which are, exhibiting these characteristics, then you can be early to identifying the themes. Right? This is what you have to look for, right? Especially if I have to further rank it, I would say, in the order of importance, one, two, and three, right? So these three factors, if you find in a group of stocks, then you can be very sure that this can become a theme. So why do themes happen, right? I think it's undeniable that themes happen. We've all seen it. We can go back and study it. But the question is, why do themes happen, right? So I think themes happen because capital always chases growth, right? Capital is a sucker for growth. Capital is crazy about growth. So capital only wants growth, right? So to give you an example, right? If a company or a set of companies are growing at 15%, and let's say they get an X amount of capital, the company growing at 45% will not get 3x the capital, they will get 10x the capital, right? Because you can find, so it's like the bell curve, right? So you can find many companies growing at 15%, but there will be a very small set of companies which are growing at 45, 50, 55, 60%, right? So the capital just goes crazy behind growth, right? That is how markets have operated, right? And that is why the valuations expand, and that is why the PE ratios expand. And you will see that whenever there is a theme, right, which has which is playing out in the market, the PE ratios will always be expensive, and the PE ratios will sustain throughout the length of the bull market, right? So if you feel that, like, let's say you're early in the theme, and you are exiting a stock, or you're saying that the valuation is too high, then that is not something which will work out, if you're doing a thematic investing, right? Because valuations will be high, and the valuations will incrementally keep expanding, because capital will continuously keep chasing as long as the growth delivery is happening, and as long as the perception of that large TAM sustains, right? So, but the key thing to really take away from the slide is this idea of this power law, right? Which is basically that if your growth is 3 times, the capital that will chase you will not be 3x, but it can be 10, 15, or 20x, right? And that is what leads to a P re-rating. That is what leads to the madness that we see, in many themes, right? It's important to understand why that happens, right? Because that is the nature of the capital, to chase growth. Before we, discuss when does the theme end and how you can identify that, and what are the factors that can tell you that the theme is ending, it's important to just quickly talk about this young and late momentum, right? Which basically means, so when I say momentum, it need not be only price momentum. It's generally the fact that, how what happens early in the cycle and what happens late in the cycle, right? Because early in the cycle, because the theme is new, the stocks will be under owned, the institutions will take time to build up their positions, and also because the base is low, right? You can keep showing growth for multiple quarters, right? But then as this growth continues, for a long time, your own success becomes a reason for your failure, which means that the expectations keep on increasing, right? And the base also keeps on increasing. So you cannot grow at the same rates that you were, growing earlier, right? And now if you look at the example of, let's say an Nvidia, right? So now what's happening to Nvidia and a lot of these other stocks is the burden of expectations is so high, and the base is so large that they are probably going into, some sort of a late stage kind of a environment, right? Earlier, when the cycle was young, they had the ability to keep growing for multiple quarters because the base was still manageable, right? So it's very important to understand this, right? This cannot, any thematic investment, right, cannot go forever, right? Like I said, your own success becomes the reason for your failure, right? So the more you succeed, the more the burden of expectations, and the more likely that you will not be able to deliver on that, right? So that is how the themes get killed, right? That is how the PED rating happens. So it's important to understand where we are, in terms of the cycle, and also look for certain clues which will tell us that is this cycle ending. So what are those clues? Let us look at, let's look at that. Okay, before that, I've seen that at least for the last many years, right? One of the ways to figure out, how early or late you're in the cycle, right? So broadly, you will see that a bull market will last for about, 3 to 4 years, right? Let's say 3 years. And the 3 years will comprise of 1.5 to 2 years of a bull run, which is about 18 to 24 months of a bull run, and 6 to 9 months of a sharp corrective phase, and 6 to 9 months of a consolidation, right? So about 1.5 to 2 years of bearishness and consolidation, and 1.5 to 2 years of bull run, right? So this is the broad numbers you can keep in mind. Of course, these are average numbers. That doesn't mean that every cycle will exactly match this, but these are the numbers you have to keep in mind. So if something has been doing well for, more than 1.5, 2 years, then you know that, purely, by base effect, right? You know that things are now in the late stage, right? So that is one way to become a bit more careful. That is one way to, try to get into a bit of a risk off mode, right? So this kind of a timeline for a cycle of 3 to 4 years, right, bull to bull 3 to 4 year cycle is what has been happening for the last many years. So one can remember this, right? So how old are we into this cycle? If you have been owning something for more than two, I mean, if a stock has been doing well for more than 2 years and a lot of money has been made in that stock, right? Then it is a sign that maybe things are heating up. That doesn't mean you have to sell or you have to completely make it zero, but incrementally you can take some steps to cut down your risk, right? So that is how you can do it. Now let's talk about how the domino really unravels, right? So how does the theme get killed? So what are those signs? So obviously the most easiest sign is the growth acceleration slows down, right? So the growth rate, a company that was growing at 50% starts growing at 35% and then 20% for the two consecutive quarters, right? That tells you that probably the story is getting over, right? So when you start seeing that, you have to start taking incremental, decisions to reduce the allocation, right? So growth acceleration slowing is one. Second is in a lot of cases, you will see that the acceleration will not slow, but it will come to an immediate screeching halt, right? There will be some sort of a surprise a quarter or, something suddenly will go haywire, right? And that is worse actually, right? Because everybody is taken by a surprise and you don't know whether it will come back on track or not, right? So that is another sign for you to incrementally take some steps to cut down the allocation. Now as an aside here, see, I am not in favor of taking binary decisions, right, when it comes to selling. I feel that selling should always be an incremental affair because, see, selling is full of regret, like we always discuss and talk about it. But that is why if you make it incremental, right, things become psychologically very easy. So if, let's say, a growth acceleration slows, then you can keep cutting your position and still retain some, because in some cases you can see that it can come back also, right? And similarly, if there is a very bad quarter, you have to take action based on the data and the fact that you cannot just keep watching with like a deer in a headlight kind of a scenario, right? So you have to take some action. So make it incremental so that psychologically it is easier, but do take that action. Right? It will allow you to take the next action also, much more easily if you have taken the first step, right? The third hint is when results are as you expected them, the price action is bad, which means that the market is not reacting to good results, right? Or seemingly good result. Now, this typically happens when something is overowned, right? Because everybody who had to buy has already bought. So there is nothing much left on the table, or a new guy is not there to buy. So in spite of good results, the price action is not there, which means that maybe a distribution has started. And this is also a good sign for you to, start cutting the allocation. Finally, sometimes you get a negative sectoral news flow, right? It will not be something stock specific, but at the sectoral level, you'll get some news flow which will lead to a bit of a correction or a bit of a doubt on the sector, right? So that also happens. Number five, something very bad will happen in a particular stock in the sector, right? Now, when the theme is there, right, which means that all of these stocks will be showing very high growth rates and consequently they'll all be having a very high valuation. Market will not tolerate any uncertainties, right? So even if any one random stock from that theme is going through some trouble, everybody else will, discount that. Everybody else will act as if that same trouble is going to impact them also. And in 90% of the cases, it eventually does, right? So if anything, any one stock also is getting into trouble, it is time to pay some attention. And finally, for the overall market correction, right? For no mistake of yours, for no mistake of the theme, if an overall market correction happens, right, then also a theme can unravel, right? Because generally what happens is, like I said, a theme is built on a bull market. A theme is built on a risk on kind of a thing, right? Which happens in a bull market. Now, if there's an overall market correction, right, then the liquidity, is sucked out. If liquidity is sucked out, then the risk on, becomes risk off. And when that happens, the PE ratios start compressing, right? And that is why you can see that your company were doing well, but if there is a broader market correction, then all of these thematic stocks can easily correct 20 to 25%, right? If that happens, then it becomes very tricky because you can't decide, because earnings wise, everything wise, you feel that there is still time here, there is still a good 2 3 years to go. If that is the case, then you should hold on. But if you're already late in the cycle and then a correction happens, right, then you have to be a bit more careful, right? But I think point number one, two, three are the best indicators, right? Because they're specific to the stock. uh, and they can give you a much clearer, decision making capability. So this is how the thematic domino kind of unravels. So this is why I always talk about, that 6 to 8 quarters kind of a theory, right? Because generally, like I said, right, a theme will run for 2 years. So anytime after 2 years, you have to get on a very, active and a very alert kind of a mode for that particular theme, because anytime any accident happens, there can be trouble, right? But in the initial 1 to 2 years, generally, even if there is a market correction, and as long as the underlying growth remains intact and the story remains intact, you will see that these themes will again bounce back and make new highs. But after the 2.5 year period is when generally they will either go into a long consolidation or they will have a sharp correction. Finally, we'll talk about third thing, right? So we discussed the market environment, we spoke about themes. So let us talk about the portfolio construction. Again, see, all these three things, right, are very, very foundational. The most foundational, obviously, is the market environment. The other two are also equally important. And I feel that people don't spend a lot of time thinking about how their portfolio should be structured, right? And I feel that is actually the most important decision. That is the decision that will really drive your long-term returns, right? So even if you're a very good stock picker, but if you have not thought through how you will, place that particular stock in your portfolio, right? Then you are doing injustice. Maybe you're leaving a lot of money on the table. So I have always, made a case for a diversified portfolio, at least, in the last many years, because the more I thought about it, the more I saw my own portfolio is in action, the more I saw other people, I realized that, the takeaway for me now is that you have to be diversified by default and you have to concentrate as an exception, right? So I'll repeat that. So be diversified by default and concentrate as an exception, right? Because diversification allows you to stay in the market, right? That's point number one, right? It removes your risk of ruin, right? Because if you're diversified, then you can survive in the market and be there for 10, 20, 30, 40 years, right? So even if you make some foolish mistakes in, let's say, one phase of the market or one cycle, there are always many other bull markets ahead of you, right? So all you have to do is survive, right? And because all that you need is one or two bull markets to really take your portfolio to the next orbit, right? So if you're concentrated and you make a mistake, right, or if you're leveraged and you make a mistake, then you can be completely out of the market, right? And the mistakes are very difficult to undo in a concentrated portfolio, right? Now, so in that sense, I feel a diversified portfolio is almost a no-brainer, right? The second is, in a diversified portfolio, right, I've spoken about this, right? It provides optionality, it allows you to take bets on many names, right? And more often than not, you will see that the names that you thought will perform the best, right, end up performing just okay, or or maybe in worst case they'll not perform, but let's say they perform okay, or they're slightly above your expectation. But that particular stock which you bought it on a whim, or you thought that particular stock is something, let me take a bet, that particular stock ends up being the best performer. So if you're a concentrated portfolio, then you cannot buy the second type of stocks, right? You only have to buy stocks where you are very sure of, that the stock is going to do well. But please understand that we are in a market, right? It is not a game of absolutes, right? If you are very sure of a particular stock, then the rest of the market, or at least many other participants, will also be sure, because everybody has the same data. So where is that edge coming, right? Right. So a diversified portfolio allows you to participate in a lot of stocks, different types of stocks, and you don't know in which area your luck will shine, right? Because end of the day, goes without saying that market is a game of skill and luck both, right? So you have to increase your luck surface area, and that can happen only via a diversified portfolio. And not only that, in the markets, right, the returns are asymmetric, right? So the reason why, why I'm talking about increasing your surface area of luck is because the returns are asymmetric, one winner can take care of 20 losers or 20 average performers, right? So one five or six bagger or one 10 bagger can take care of so many other mistakes. And that can happen, and a 10 bagger typically will happen. Mostly you will see these kind of returns are seen in diversified portfolios, because you are, one is you will be taking a bet into something where the conviction won't be very high. See, multi-baggers come not from high conviction, but multi-baggers, the conviction builds up later. But when you would have first bought it, the conviction will not be there. It will be based on one particular quarter or of, some sort of a news flow, or you think there's some catalyst and you take a small bet, right? And then you build up the conviction, right? So the diversified portfolio allows you to take those kind of bets. Third and most important is mistakes don't hurt you so much, right? Decision making becomes very smooth. So if you are a concentrated investor, right? Let's say a stock that you own in a large quantity has fallen, then you again will be, you'll be completely confused whether I should sell, whether I should average, what should I do, because the impact of that decision is very big, right, on your returns, right? Similarly, if the stock doubles in a concentrated portfolio, again, because you made a lot of money, you will be confused whether I should sell, book half, or sell everything. But end of the day, what will happen is, because you're so confused, right, you'll end up taking suboptimal decisions, right? So in a diversified portfolio, mistakes don't hurt. You can take, you can if you've gone wrong somewhere, you can take a decision very swiftly without worrying about how much that particular decision will impact your portfolio. And that allows you to stay on top of your portfolio and have a much better clarity of thought. And finally, related to the second point, but it frees you to bet, right? A lot of times in concentrated portfolios, you cannot take certain, outlier bets, but in a diversified portfolio, you can. So my experience overall has been that people think that diversified portfolio dilutes returns, but I feel that it will enhance your return over a life cycle of investing, right? Uh, Concentrated portfolio only works, it might work in a particular cycle, it might work in a particular situation for you, but a diversified portfolio allows you to stay in the market. It increases your luck surface area. It gives you more clarity of thought to take decisions. And I feel incrementally it will, over a cycle, right, or over multiple cycles, it will allow you to actually earn more returns. It's counterintuitive, but that is what I have seen, work in the markets. So my theory is this, right? So you have to be diversified. And when I say diversified, I don't mean 100 stocks. But so I think the sweet spot is about 30, 40, 50 stocks, right? The exact number is up to you, but you have to you have to fairly spread out the risk, and you have to have a fair number of stocks. Now, the way to concentrate within a diversified portfolio, I feel, is through themes, right? So you have to start thinking about your portfolio in terms of themes. That is, if you are an active investor, or if you're an investor who wants to ride these themes, right, then you can break down your 30 to 40 stocks into multiple themes. So right now in the market, there are many themes that are working. There are many themes where the earnings growth is extremely high. So what you can do is you can divide your portfolio into 30 to 40 stocks, and maybe you have, 5 or 6 different themes. And each theme, can have 4 or 5 different stocks, right? So some of those stocks may be, slightly larger market cap stocks. Some of those stocks may be slightly smaller market cap stocks. So that depends upon how you want to construct it. But what this thematic split of your portfolio does is it allows you to not only participate, in many themes, it also allows you to outperform, generally on a continuous basis. Because what will happen is, if theme one and theme two stops, that is precisely when the capital will start flowing into theme three and theme four, right? So that is how bull markets work, right? On a continuous capital rotation. So if you can identify these themes, allocate on the basis of your expectation from each of these themes, then that is a good way to quasi concentrate in a diversified portfolio, right? So this is how I think about portfolio construction. Within this, now you can do this in many different ways, right? So an option A is that all these themes, right, all of these, let's say 5 6 themes, can all be growth oriented ideas, or growth idea oriented buckets. But there may be some investors who can say, I want to have 3 growth and 3 value themes, right? So I want to have certain value stocks and I want to have certain growth stocks, because I want a balance. Now there may be a third investor who might say, I want growth and I want defensives and I want special situations. So how you really construct this, right, is completely up to you, your risk profile, and your needs. But this is a framework, right? So you be diversified, and concentrate via multiple themes, right? So have 4 or 5 or 6 different themes which make up your portfolio, and start thinking of the portfolio through these themes, right? So think in themes, not in individual stocks. So that will also give you a lot of clarity of thought. And within the themes, like I said, you can look at whether you want to focus on growth or value or pure growth or however you want to split it, right? Large caps, within the theme, you can say, I want to be more into, mid and small caps and very little into the large caps. So you can do all of those, permutations and combinations. So this is about portfolio construction, so I think, to kind of conclude and come towards the, closing, right? So I think most of the professionals, like I said, obsess on these two elements, right? Market environment and portfolio construction. They give a lot of thought to this, right? If you've seen the movie, was it the margin call? I mean, that popular dialogue, right? Where in the boardroom they're discussing, right? And if you listen to that guy, right, the main guy there, like what he says is that my job, right, the main guy's job is to figure out when the music will stop, right? This was in the 2007-8 crisis, right? So he says that his job is not to do stock picking, is not to do allocation or do trading. He said my job as the top guy is only to figure out whether the music is stopping or it's slowing. And so what he's essentially saying is his job or the guy's job at the top is to understand the market environment and and then drill down that information to the rest of the portfolio. So market environment and portfolio construction, right? These are the two areas where you have to give a lot of thought. A lot of thought goes into stock selection, theme selection, but the foundation is, the first two. So I think if there is one takeaway from this whole discussion, I think it has to be that you have to, think a lot more about the first two elements. Because anyway, the third and fourth, we are already doing a lot of thinking, but the first two is where the real game-changing, concepts are. Finally, like I said, right, I'm not going to give you a list of books, but I'm going to give you a certain mindset or ways of thinking, right, which will probably help you in the markets, right? So I think one is number one, obviously is to internalize that markets are inherently probabilistic, right? A lot of people work with this mindset that there is a formula or somebody knows a formula, or if I can crack this, then I will be able to reach my particular goal, right? But the markets don't work like that. Markets are very, very probabilistic, and the probabilities keep changing on a daily, weekly, monthly basis, right? So you have to inculcate in yourself probabilistic thinking, whether it comes to identifying stocks, holding stocks, or the portfolios, right? So you have to think in terms of probabilities, and you have to keep updating your probabilities as the new information comes in, right? And the second skill is really to learn to read between the lines, right? So whether it is a con call transcripts or a management interview or a news flow, you have to learn to two things, right? One is read between the lines. I try to understand the context and what they are trying to say and what that means for the eventual numbers. And second is, I've not put it there, but probably more important is to be independent in your thought process, to be able to think independently, right? You have to be able to make sense of a con call or a news item or any analysis, right? It has to make sense to you, right? And that is when you'll really be able to have more conviction, and pick the right themes, pick the right stocks, right? So you have to learn to think independently, and how you can want to think independently is something we'll cover in the next couple of points, right? The third one is to have a process orientation, right? So you have to think of so this is a serious business, right? Investing is a serious business. You have to have a process. You have to be very clear, like I said, right? Whether you are going to have a diversified portfolio, concentrated portfolio. If it is diversified, how many stocks am I going to own? What is going to be my starting allocation, right? What is going to be the number of themes I will own? What is the decision on which I will buy? What is the decision on which I will, start incrementally cutting? Everything has to be as clearly defined as possible. You can, of course, it is not like you stick to that forever, right? It's a refinement, it's a game of refinement. So you keep refining it as the years go by, as you learn, but you have to have a workflow, right? It cannot be a random. If you are doing random things, the results are going to be random, right? If you're clear what you're doing, right, then it will be so much better. Like to give you an example, right? So, we had a very bad drawdown in the February March period, like everybody did, but I was very clear that, see, we are in the small cap space, right? We are focusing on the small cap space, and small cap space are known for sharp drawdowns. They are known for deep drawdowns, right? So I was very clear in my head that what is my portfolio, what do I own, what are the pros and cons of that, right? So that allowed me to sit through the pain and eventually take advantage of the amazing rebound that we saw. So if I did not have that clarity of thought that, okay, what is my portfolio made of? And if that thinking had not happened earlier, then I would do random things whenever a bear market came or whenever a correction came. So the more clarity you have, the better off you are. In the recent tweets, I also spoke about having constraints, the idea of having constraints, right? You have to build constraints into your process, because if you don't have constraints, you will do all sorts of all sorts of things, and you will not know how to take decisions when things go wrong. You have to have constraints, which is a part of optimizing your workflow. Final 3 points, right? So watch market action. So when I say watch market action, what I mean is, you have, books are one thing, right? But you have to watch what is happening in the market and try to learn from that, because the best teacher, right, if is the market itself. It is not available in any book, right? So if you see a stock, doing extremely well, go back and study why that stock did well. If a stock is, had a very bad phase, you try to understand what happened. Why did this stock have this kind of a price action? Why did this stock fall so much, right? So if you want to be, a surgeon, right, you have to do the surgery, right? Similarly, if you want to identify winners, you have to study the winners, right? So you have to watch the market action. You have to watch how the market reacts to the news and keep learning from it. And finally, watch yourself, right? Which means that how did I react in the last bull market? What did I do? What did I do in this bear market? How did I react? Because see, there is no point if you don't learn from every cycle, right? If you are just focusing on doing the same things again and again, then what's really the point, right? So you have to learn to watch yourself, right? So for me personally, right, that is why I'm very proud of the way I played this bear market. I was not at all worried, because I knew that I was very clear that what is happening on the market. I was not sure of the timing of it, right? It could have gone on for longer, but I was very sure what is happening in my portfolio, what is happening in the market. It was a very, very natural thing. Like if you go back and read my market notes, which is on the blog, right? So you will see that multiple times I said this is natural. There is nothing to be surprised of, right? It's a cycle, right? And it will turn, right? It will turn. And so that 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 ability has come because I learned from my own behavior in the previous bull markets or previous bear markets, right? So my next frontier is, bear markets. I feel to some extent at least, I've been able to, figure it out, right? But now the next frontier is really to learn how to ride a bull market and exit without giving up a lot of gains, right? Giving up some gains is natural. You cannot buy at the bottom and sell at the top, right? But how can you also play the bull market well? That is what is the next frontier, right? Because in the previous bull market, we did extremely well, but we also took the drawdown. Can I contain that drawdown? Is there a sweet spot? No, that is what I'm trying to learn. And finally, study individual stock moves. It's part of the previous point that I spoke about, a watch market action. But what I mean by individual stock moves is that so depending upon whatever your strategy is, right, you have to study that particular stock. So if you're a growth investor, study stocks which are growing, extremely fast. Study their price action, study their, news flow, corporate announcements, con calls. So what exactly, happened, which led to this stock becoming a multi-bagger. Similarly, if you're a value investor, focus on stocks which have done extremely well in the last 1 year, and go back and check which of those stocks started out as value stocks. What can I learn from that? So holistically, I would say you have to be involved with the market. You have to be continuously learning from the market, and that is what this game is all about. It's a game of continuous refinement of your process and building a clarity of thought, right? And finally, I will say, I'll close with, the fact that you have to do something that sits with your personality, right? So if you are somebody who cannot do growth investing, then you should find something else that works for you in the market, right? Yeah, there are some people who are very value conscious who cannot, buy, themes or thematic stocks. There are many ways to make money in the markets, right? I've always said that, right? But if you are doing something that is sitting with your personality, then there is a very high probability that you will succeed, and that is what you have to try to do. So I think with that, I will stop my presentation. And I hope you find value in this.
Yeah, I think it was extremely valuable, sir. I think I took a bunch of notes also. We'll just have, sir, some questions. I think from the presentation only, I made a couple of questions. One of the questions or one of the things which troubles the retail investors a lot is that कि मतलब पूरा जो वैसे मतलब it's a very counterintuitive thing. कि I think because our education system is like this and how we've been taught, like a lot of engineers come into market, a lot of doctors come into the market, but they have a very deterministic mindset. And the challenge which I've
Yes.
experienced ki people find it tough to think in terms of probabilities.
Yes.
So,
Yes.
are there any nuances or are there any मतलब ऐसी कोई ट्रिक्स है सर कि जिससे डिटर्मिनिस्टिक माइंडसेट और प्रोबेबिलिस्टिक माइंडसेट में आ पाए? बिकॉज इसमें तो ऐसा नहीं है कि मतलब आपने कोई एग्जाम दिया 10 on 10 मार्क्स आए. कभी कभी फीडबैक विल बी सॉर्ट ऑफ मल्टी मंथ और मल्टी बेसिकली ईयर इन नेचर.
Correct. Correct. No, I think that is also a big problem for fund managers also, because a lot of times a section of investors are there who think that it is like, it's like doing a surgery, right? It's like, you have to succeed, right? How can you not succeed, right? Because you are in the markets, you're following it 24/7. How can you not make money every year, right? So no, I don't think, at an individual level, I don't think it's a matter of trick, right? It is a matter of really understanding, because, markets are an amazing place, right? Because, like you correctly said, right, in the real world, right, things are very deterministic, right? If you do X plus Y, you will get Z, right? More or less. But in the markets, that is why people are not able to make sense of a lot of things, right? Stuff like, if earnings are so good, then why did the stock fall? Right?
Right.
Stuff like that, right? So I think people have to understand that market inherently is a game of predicting the future, right? If they understand this one line, I think everything will fall into place, right? It's a game of future. Everything that we are doing is trying to predict what is going to happen, in the next few months, few years, or few decades, right? That is the whole game. And inherently, the future is probabilistic, right? You don't know because there are so many variables out there, right? So I think if people realize that, it's all about trying to, figure out what's going to happen next, right? And if you think about all the variables out there, right, whether it is the Indian politics, the Indian economy, the global politics, global economy, the people, running the show now, the people who will run show 3 years down the line, right? We have no idea how things will change, right? So it is inherently, it's about the future, and future by definition is something that is probabilistic, right? But I don't think there's any trick, right? It's something that people have to learn by
Right.
doing.
I think one thing which like some of us investor friends do is that we keep playing poker from time to time.
No, but this is, I think, this is poker on steroids, no, market.
Right, right.
Market is, poker is still okay, because here you have, you can have absolutely random things, that you have been seeing, right?
Correct.
Absolute random behavior, impacting the markets, right?
Right.
So yeah, absolutely.
I think another question that comes up is that, especially in thematic investing, that we have seen कि leaders always lead, right? That the leading theme leads. बट जैसे गुड रिजल्ट्स प्लस बैड प्राइस एक्शन होता है, जैसे फॉर एग्जांपल यूएस में एनवीडिया है, राइट? तो एनवीडिया
Yes,
स्टॉक पीक्ड आउट आई थिंक 12-13 months बैक, बट द रिजल्ट्स हैव बीन स्टिल स्टुपेंडस. दे आर ग्रोइंग 85-90%. But at the
yes,
same time, the AI rally has broadened to other sort of areas, optics, memory,
yes,
other areas which it has gone to. But
yes,
but the leader is not doing well. That is Nvidia. So in
yes.
this type of basically scenarios, how do you think about it?
So I think, two things, right? So one is, this particular slide whereby, so NVIDIA as a stock that has been doing, so this is, so we have to see things in the context, right? It is,
Right.
so a good results and bad price action at the beginning of the cycle and the end of the cycle are completely different things. So one thing very clearly is that we are at whether it's the end or not, we don't know, but we are in the later half of the cycle, right? So we are at the later half of the cycle, and the base has become extremely big, and specifically for NVIDIA, I think there is a big risk of margin compression, right? Because a lot of other people are also getting into chips, right? So they were almost a monopoly, and nobody else was in the game. But over the last 2-3 years, a lot of people have entered the chip business, and a lot more are entering now, right? Especially even China, within the US, there are many companies plus China, right? So I think that is what the market is kind of trying to predict. And to answer your second, question, right? It is basically, this point number 5, that, once the capital has flowed to the leaders, right, it typically looks for other areas to participate in the growth, right? So again, it's a story of the later half. So all of this tells us that we are in the later half, whether we are near the 70% or 90%, that is nobody knows. But I think very clearly we are in the later half. So it makes sense to, like I said, right, take incremental decisions, right? It doesn't have to be an all or none. Like, you've made a lot of money in that theme, let's say, and so take some money off, because see, the theme is not like owning a secular growth stock which will do well for a decade. That's a different game. A theme is something where the returns of 10 years are compressed in 3 years, right?
Right.
So you have to realize that. So if you made a 50-60% CAGR for over 3 years in a particular stock or a particular thing, we have to know that trees can't grow to skies, right? So in that sense, I think all of these examples that you give, whether Nvidia, Nvidia basically, we said that it's not reacting to the good results, right? To point
Right.
number 3, right? So I think we are in the later half, and that's the takeaway. And the action item is basically that you have to reduce your allocation and book profits, and still keep like something at the base level, because it cannot be over yet. But it may go into a consolidation phase, in the best case, and worst case, it may see a sharp correction.
Right, right. I think there was one of the slides that you presented that just has shown कि मतलब जो TAM होता है एकदम new आ जाता है, right? Like there's a
Yes,
open-ended TAM in the companies. Like
yes,
I was just correlating with it कि especially post COVID we have not seen like कि there's a cement sector है. We won't see that a new TAM has opened up, right?
yes, yes,
Unless consolidation plays out. We haven't seen a new TAM opening up in the sugar sector. मतलब ethanol एक साल के लिए आया था, but then we saw कि competition हो गया. Like
right.
so in terms of finding what is new in the market, right? When it comes to thematic investing, so there are some old age sectors and then there are some new age sectors, right? So
Correct, correct.
is it also probabilistically right to say कि जो newer time है या फिर जो newer opportunities है, that usually ends up coming in what is new in the market versus what is old, like cement, steel, etc., etc.
Broadly, yes. But because see, any bull market, right? It has to. It will generally happen in a set of stocks which are under-owned, right? And by definition, let's say a cement or a sugar, or let's say some of the other consumer names that we have, right? All of them. So the first requirement for a theme to work is that there has to be under ownership, and there has to be a new TAM or a new story that allows the P re-rating to happen. Because end of the day, we want to see a super high revenue growth and a P re-rating, right? So that cannot happen in the old age companies, right? So I would say 80 to 90% of the times it will be new. It will be these new companies, and that is why I gave the example of PSU banks. Right? PSU banks were a theme, but they were not. So there's a difference between these three themes, right? Defense, hospitals, and PSU banks. So defense was checking all our boxes, but PSU banks was not really doing that. Right. So, I wouldn't really categorize this as a theme, but it was it was a sectoral thing which did well in that phase, right? But it was not checking all the boxes. Now,
Right.
an example like Nvidia, for example, right? Nvidia was an old stock. It is not a new stock, right? But they completely pivoted to something new. So you have to be open to that thought also, right? So you have to be open to that idea that if an old economy company or an older company, let's say, which has been in the markets for a long time, if it is doing something new which can meaningfully, change its fortunes,
Right.
then it can qualify, right? So, but again, what happens is you want to see this, you want to see this revenue growth, right? You want to see the super high revenue growth, which Nvidia showed. So I think that's why I said, right, the criteria are in the order of importance, right? So 1, 2, 3, and 4, right? So the old economy companies, if they suddenly start showing very high revenue growth, then they can be a theme, right? But it's unlikely. I think I would say 80-90% of the time it will be something new.
Right, right. I think a friend of mine, he was a big bull in like PSU banks in 2021. So he used to say कि ये तो old balance sheet has become a new balance sheet, So that was his rationale.
No,
कि world
correct,
economy company मतलब the completely balance sheet has transformed.
correct. But TAM is not there. No, the
Right.
TAM is still limited, right? It
Right.
was more of a cleanup story. It was more of a like a mean reversion, I would say, right? They were beaten down and they were completely underowned. Now things are improving, so they came back to fair valuation from a distress valuation.
Right, right, right. Another thing, I think some of the tools that you use, or what is your thought process of assessing the market environment? So, usually, market environment use करने के लिए, are there any sort of like basically activities that you do? कि different sectors का you look at charts or sub-sectoral indices, and how do you go about it?
Yeah, so I do multiple things, right? So one is I have in trading view, so I have a macro watch list, right? If you want, I can maybe share that. So I have like one of the things I do is I have this, macro watch list, so which basically has all the global markets, right? It has the global stocks which are generally leading, right? So I'll have all of these stocks. I'll keep adding, removing from this. I'll have the commodities, the currencies, the precious metals and all of that. And then I'll have the Indian indices and I have crypto, which you can get a sense of, if you use to get a sense of risk on this stuff. So this is like a working list that I have, right? Which I have to look at daily, which in the so try to develop an awareness of where what the market is doing and what are the leading stocks doing, and. So this is one way to do it, and the second, of course, is to uh, be you have to be glued to the news, right? So I try to read, a couple of foreign newspapers also, and because that gives you because Indian news to anyway we get and we're always consuming it, but to
Hmm.
get a sense of what is happening, I look at a couple of like FT or the Wall Street Journal. So I have a CNBC, the World website. I have a look at that, right? And yeah, I think that's about it, right? That is how, and then you look at stuff like the market breadth. You look at stuff like that. So it's a mix of things that you put together to really build your sense of what the market is doing.
Right, right. I think just like last two or three questions from my side, because I
Yeah.
think this is a way. I thought the presentation was very fascinating because thematic investing, you have sort of made a very process wise thing. So one question which arises is ki how do you see if a theme has gone out of favor or it's just a temporary correction? Because I've seen like sometimes even stocks in a strong theme, whenever correction comes, I think I remember this. I think there is happened in TD Power in 2020, early 2025, when promoters sold some stake. It went below 30 weekly MA, and a couple of other power stocks also corrected at that point of time. So a question at that time arises ki because of price action, all of a sudden the sentiment turns very, very negative in the short term. But if you are a believer in the theme, how do you ignore technicals and keep riding the theme peacefully over like next multiple quarters, 2 years?
No, I think see, number one is I don't use the technicals or price action to exit, right? Because it can really take you to the cleaners, right? Because a normal market correction can throw you out of a very good position. So I generally primarily use price action to identify, where the capital is flowing, right? So I don't use it beyond that. I would look at it, but unless there is a news correlating the price action, right? Purely on price action, I will not exit. So I went through, the thing that you mentioned with, let's say, TD Power or even a PGEL.
Yeah.
I remember, that howler of a result that they gave, but before that, it had went through, multiple corrections. So if you use any moving average based kind of a thing, and you will be exiting at the worst possible time,
Right.
right? So number one is I have a constraint, right? That I don't generally I will not take any decisions until the result, right? So I always wait till the result, right? There may be exceptions to this, but I'm saying generally speaking, it's a constraint I've imposed on myself that I will not act. If there is no news, I will not act on the results. Most recently, I did this in car trade, right? It was beaten out of shape, right? And even the results were good, right?
Right.
I did not use any technical, nothing. I was just waiting and I was just, in fact, post the recent result, one would want to add, just to give you an example of how you manage the position, right? Uh, so what you have to see to answer your question is, again, it comes back to the same thing, right? So how long has this cycle been going on for this particular stock, right? When
Right.
did this stock start rallying? So if the stock has been doing well for like I say, right, more than, let's say 8, 12 quarters, right, then you are in that danger territory, right? That doesn't mean you sell, but that is when you probably have to take the price action a bit more seriously, right? Is it getting distributed? But if you're early in the cycle, if you're in the first half of the cycle, then I don't think, because the examples that we discussed, right, they were all in the first half of the cycle,
Right.
right? So that is how you figure out, right? As long as there is no negative news, as long as the earnings is good, as long as the guidance is good, I think you have to just ignore the price action if you are in the, the first half or the first, 3/4 of the cycle.
Right, right. I think just one more question from my side. I think when we have seen the market indices or the overall market environment over the last couple of years or quarters, so we've seen that 2018-19 में it was large caps or consistent compounding theme which was doing well. And then post 2020 we saw defense or some of the PSUs doing well. So whenever there's a bull market, I think how important is to also see कि जो indices है, चलो sectors छोड़ के अगर indices भी देखते हैं, right? So how important it is to see which index is leading it, because like currently like it's something which I've observed कि it's the smaller or the mid cap names which are generally outside the large caps or Nifty 50 or Nifty 100, which have been the leaders of the current early stage of the bull market. So how
Correct.
important it becomes to spot the कि ये किस index में किस type of या size of companies में अभी मतलब environment has turned basically.
When you're saying you're asking how to find it, or how important is it to
How
focus on those in
important is it? I think fine के लिए तो सर वो chart से one can check ratio charts and stuff.
correct, correct. No, I think what like where the action is happening is actually, I mean, the way I think about it, it's a side effect, right? It's more of, so I see my thing is, so that's what I'm saying. You have to have clarity on your thought process, right? So my thing is I want to chase high revenue growth, right? Now that revenue growth isn't, so let us say, stocks like Power India, these are all large cap stocks, right? More than a lakh and a half crore market cap, right? But they are, in spite of being large caps, they are still doing well. So I think it's more of a bottoms up kind of a thinking that we have to have. We have to look for where the growth is. And I think that is what the market also does, right? So why is Nifty underperforming, right? It is not because the market has a problem with Nifty, right? Because the growth is not there. So
Right.
look at all the constituents of Nifty, right? There is no growth in Nifty, right? And the growth, so the market chases growth. But if the growth is there in both the places, then there is the phase where Nifty and small cap both are showing decent growth for their own size, right? Still, I have seen that over a cycle, you'll make more money in the the broader market, right? Because that is where the beta, by definition, is higher, right? So I personally feel that for an active investor, and this may be a controversial statement, but for an active investor, right, whether the large caps are performing or not performing, right? You have to hunt in the outside the large cap space, right? Because if we are devoting so much time for it, right, and if all that you want to do is match the large cap returns, then mutual fund ko paisa run देना first. Then why are you?
सही बात.
I would say, I mean, not really to get into this business of, कि कहाँ पे ये हो रहा है. I think it has to be bottoms up, and your own portfolio will, take you there, right? And for the active investors, I would say, forget about, the top 100 stocks. I mean, not like that, but don't have this mindset, focus on where the revenue growth is. And I think automatically the market will take you, where the capital will likely flow.
Right. Right. So I think be a follower of the flows and liquidity, and market will take you there. So
Be a follower of earnings.
yeah.
Revenue growth, be a follower of to make it very specific, be a follower of where the revenue growth is, because revenue growth is what the market loves, right? So you take out the big winners, right? You'll see most of them will have high revenue growth, or there will be some perception that the revenue growth will come.
I think there's a meme also, which I think I'll just share in the video also, key is that key. First we look at margin of safety, then we look at moats, and then finally you stand and you said, and you look at accelerating revenue growth. Right. So that's the
Absolutely.
last stage.
Absolutely. But also important to understand, like I finally ended my presentation, and see, not everybody can,
Yeah.
the personality fit also has to be this. So what we are doing is relatively a higher risk. So accelerating earnings growth and playing themes, right? And it comes with its own. See, there is no free lunch, right?
Right.
Just you will not get to make high CAGRs without taking the risks. So people have to, and that is why I push for a diversified portfolio. Because if you are playing in the high growth area and you are going extremely concentrated, then things can really go haywire. If you any black swan happens, anything happens, right? So that is why the portfolio construction layer is to manage the risk so that we can operate in a high growth and this kind of a segment of the market.
Right. Right. So I think, Prabhakar sir, one last question from my side. Any piece of advice for a young investor who's doing active investing? Okay, how to go about their own learning thought process and how to sort of like think in terms of probabilities that we have already discussed, and any just piece of advice for them.
Well, I would say learn from the actual markets, right? But, I mean, you read books and all that is important, but whatever strategy you like, right? Like I said, right, if you're a growth investor, right, take out the top 50 or 100 stocks which have done well in the last 1 year or 2 years, and do a case study of why did they do well, right? That is what will build your own patterns, and that is what will build framework in your mind. That is what will give you confidence because you would have done the work, right? So study the winners and figure out for yourself, why did those stocks do well? What were the parameters? Was it the growth? Was it a management change? Was it a new product? What led to this rally? Right? Was it the bull market? What was it? Right? What led to this rally? Understand that for yourself, right? And then automatically you will have the patterns build up in your mind. And more importantly, you will have the confidence that next time you see that pattern, you will be able to bet and actually make money. And that is how you will grow.
Right. Right. So I think with this, I think we'll end the podcast. It was really helpful. And I
Sure.
think hopefully the audience gets a new lens of looking at themes and their process ends up improving. That's the idea of doing these podcasts.
Absolutely. Absolutely.
Thank you so much, sir. Thank you so much for willing to do this. Thank you so much.
Thank you. Thank you, Ishmohit. Thank you.